This is the Sensei podcast, where we help you make sense of investments and financial markets, where we help you make sensible financial choices. I am your host, Ndwati Karanja. Dave Ramsey, the author of the book called The Total Money Makeover, says that head knowledge accounts for about 10% of your success in finance. The other 90% comes from your behavior. Warren Buffett as well says that you do not need to have a high IQ to be a successful investor. And even if you look around at the people who are successful financially, you'll find that there are people who have advanced education and the others who didn't even probably make it past high school. When it comes to money, it boils down to your behavior. Investment wealth doesn't come from secret knowledge or secret skills that only geniuses have. Rather, it is from a lifetime of having good investment habits. Jack Brennan, in his book More Straight Talk on Investing, outlines 3 important habits that you need to develop when it comes to investing. In this episode, we are going to go into these 3 habits in depth so that we can understand them better. These 3 habits are living below your means. The second one is be a buy and hold investor. And finally, do not keep score of your investments too often. Let us start with the first of these. Living below your means is the first good investment habit that you need to develop. You do not need to wait for a high salary increase or a high paying job or an inheritance or any other type of windfall that is going to jumpstart your investment journey. The way you do it is you live below your means so that you have money to save, then use that money to invest. Something that usually sometimes holds us back is we are always waiting for that big amount of money that you're going to receive at once that is going to change our lives in a fundamental way. Just look at social media where you usually see those prayers that say, type amen, and you're going to receive a huge financial surprise in the next week. There are people who experience this. If your parents have been saving up money for you, you might get to the point where when you're old enough, you receive a huge amount of money. I remember a few years ago, I was working at a bank as an intern, and there's this day an Indian man who came in and he had been saving money for his son from the time his son was born, and the amount had grown to almost 1 million shillings. And on just one day, he withdrew that money, gave it to his son, and his son invested that money in a business. This is what we tend to dream about, receiving a windfall that is going to change our lives. However, that is not how it works out. And if you wait for that, you'll end up never investing and you'll end up wasting your resources. Because the truth is, over your career, you're going to receive a huge amount of money. As I was preparing for this episode, I did the math. Imagine you're starting off your career earning, let's say, 20,000 shillings per month. And let us imagine that that amount increases over the years to keep up with inflation. By the time you are retiring at 65, let's say, you're going to have earned 38 million. 38 million will have moved through your hands. And if you just save 10% of that, that is going to come to 3.8 million. If you regularly invest that 10% from your salary, by the time you are retiring, you're going to have between 10 million and 61 million, depending on how the markets do over that period of time. Therefore, with the amount that you receive every month, with the discipline of living below your means so that you have money to invest, is going to be one of the most important habits that is going to change your life. By the time you are retiring, by the time you are in your 50s, in your 60s, you are going to have accumulated a huge amount of money. Therefore, that is the first important investment habit that you need to develop. It is going to help you build your investment capital. And the next habit that you're going to talk about is going to help you know how to invest that investment capital that you're building up. The second good investment habit that you need to develop is buying an investment and holding on to it. Our idea of a savvy investor is someone who is always buying investments and selling them at the right time to make returns. However, that approach is not going to make you a successful investor. Constantly moving money from one investment to another requires that you can predict the future. And studies in investments all over the world have shown that even the most intelligent experts are not good at predicting the future. Think about it. When you need to buy something at a low price and then sell it at a high price, you need to first of all predict the right time to buy, and then you need to predict the right time to sell. The odds of you making those predictions correctly every time is very low, and you are likely to keep making mistakes over time and lose your money. There is a saying in financial markets that goes something like this: if you want to make a small fortune, you need to start with a large fortune and then do a lot of transactions. You reduce that large fortune into a small one. Therefore, that is not the approach that you need to take, where you're constantly moving your money from one investment to another. Rather, you need to buy investments and then hold on to them for the long term. Still going on with that illustration of you saving a certain amount of money every month from your salary over your earning life, you're going to experience the benefits of something that is called dollar cost averaging. What dollar cost averaging is that you stop trying to predict the market. Rather, you invest constantly that 10% or more or less from your salary every month. What is going to happen is that you're going to find that there are times you're going to be investing when the market is high, there are times you're going to be investing when the market is low. However, on the long term, you'll find that it is going to average out, and the total value of your investments are slowly going to be moving higher. You're not going to be taking great risks with your money. Therefore, systematically investing a certain amount of money from your salary every month and then planning to hold on to it for the long term at minimum 5 years is going to help you grow your investments over a long period of time. And as time goes by, you'll find that you are becoming a wealthy investor. Therefore, remember that constantly buying and selling investments is not a good habit to develop. Rather, develop the habit of holding on to your investments. And something that is going to help you hold on to your investment for the long term is the third and final habit that we are going to cover. The final good investment habit that you need to develop is don't keep score of your investments too often. The market is always fluctuating, and sometimes it is trending upwards, sometimes it is trending downwards. And to avoid becoming nervous every time it does this, you need to avoid keeping score of your investments too often. Something that Benjamin Graham, a legendary investor, says is that in the short term, stock markets are a voting machine, and in the long term they are weighing machine. What does this mean? In the short term, the prices in the stock markets reflect what investors think about the prospects of the company. There are times that the investors are moved by their emotions and they think the company is going to do well, then they push the price up. Other times, because of their emotions, they think it's not going to do well, they push the price down. Therefore, when you look at the markets on a daily basis, you get that emotional reactions that investors have to the information that is available to them. However, on the long term, the stock market is going to get to the point where it judges the value of the companies correctly, so that it weighs the value of the company, so to speak. And therefore, in the long term, you can trust that the market is going to be correct. Therefore, do not react to every one of these movements that are due to the emotions that are currently prevailing in the market. Rather, trust that trend that is going to develop over the long term. If you pick a strong company with good prospects, or you pick a unit trust in a company that you can trust, then holding on to the investments and not reacting to every fluctuation in the market, even the times when things seem to be going bad, is going to help you become a good investor over the long term. And to just help this point sink in, every time your investments go up and you think you're doing well, then they retreat and you think that you're not doing very well. Remember that those are just paper gains. For example, if you invested in a unit trust 10,000 shillings today, then 1 year from now, the value of your investment becomes 30,000 shillings. You'll have felt that there is a gain there. After that, let's say in the second year, the investments, the value comes down to 20,000. If you're like most people, you're going to feel like you have made a loss. However, when you think about it, you have still made a gain from that initial 10,000 shillings that you invested in. That gain of 30,000 shillings was just paper money, and the only time that you actually make a real gain and actually make a real loss is when you sell the investments. So that is why you need to avoid keeping track of your gains too often. It's going to make you nervous, it's going to discourage you, and it's going to make you sell investments that are good in the long term because of these daily or monthly fluctuations that you might see. A good rule of thumb is not to check your returns more frequently than 3 months. Once a quarter should be sufficient for you to be checking your returns, and it's not going to make you nervous at all. Let me conclude. Investment wealth isn't from secret knowledge or skills that you might have. It is from a life of good investments habit. First of all, learn to live below your means. Save the excess amount that you have, and then systematically invest that money in the stock market or in unit trusts. Once you invest the money, plan to hold it for the long term, at least 5 years. And finally, avoid overreacting to daily or monthly events, and do not keep track of your investments too often so that you are not constantly nervous. These 3 habits are going to help you become a successful investor over the long term. And the sooner you adopt these habits, the longer your investments are going to enjoy the benefits of compounding. If these habits are not part of your system yet, then you need to adopt them immediately. Success does not come with knowing much. It comes from putting to effective use the little that you know. And the way you put to effective use the little that you know is through good investment habits. This has been the Sensei podcast. We release new episodes on Wednesdays and Fridays. Please subscribe and leave a comment on your favorite podcast provider. I am Ndwati Karanja. Until next time.